Good morning, Alex and friends. I'm Grace. Today is Tuesday, April 8th, 2025, and you're listening to Alex's News. The weather in Riverside today looks quite pleasant, with a high expected around 83 degrees before dropping to a low of 58 degrees overnight. Coming up on the show, we'll explore the reasons Wall Street is getting closer to bear market territory and what that signifies. We will also investigate why finding affordable childcare options has recently become a significantly tougher challenge for many families across the country. Stay tuned for details on these stories and more. Coming up next on Alex's News. We start this morning with Wall Street, where investors are feeling decidedly bearish. The markets have been teetering on the edge of what's known as a bear market. Joining us now to break down what this means is our business reporter, Ethan. Ethan, thanks for being here.
Happy to be here, Grace.
So let's start with the basics. We hear this term bear market thrown around, but what exactly does it signify for the average person?
Right, it sounds quite dramatic, doesn't it? Essentially, as defined by outlets like CBS News and U.S. News and World Report, a bear market is declared when a major stock index, A, think the S&P 500, or the Dow Jones Industrial Average A, drops 20% or more from a recent high point and stays down for a significant period. The Seattle Times notes, the name likely comes from the image of a bear hibernating or retreating, the opposite of a charging bull market, which signifies growth. It usually reflects falling investor confidence and can sometimes precede or happen during an economic recession.
Okay, 20% is the magic number. How close are we right now, as of this morning, April 8th?
It's been a nail-biter, Grace. According to reporting yesterday from CBS News, the S&P 500 was down about 18.4% from its record high, set back on February 19th. U.S. News and World Report had it slightly less, around 17.6% down at their time of reporting yesterday. However, data analyzed by Perplexity API confirmed that at the market close yesterday, April 8th, the S&P 500 finished just about 19% below that February peak. So technically, it hasn't crossed that 20% threshold yet. But it's worth noting, as U.S. News pointed out, the tech-heavy NASDAQ index is already officially in a bear market.
So the broader market is holding its breath, but the tech sector is already feeling the chill. What's driving this widespread anxiety? News reports seem to be pointing fingers in one particular direction.
That's right. The dominant narrative, according to CBS News, U.S. News and World Report, and the Seattle Times, centers squarely on the Trump administration's new trade policies, specifically, tariffs on imported goods. We're talking about a proposed 10% baseline tax on imports across the board, and potentially even higher rates for countries with trade surpluses with the U.S.
And how are these tariffs rattling the markets? It sounds like more than just numbers on a spreadsheet.
Exactly. These tariffs are sparking fears of a global economic slowdown. CBS News and U.S. News highlighted that China has already vowed retaliation with its own tariffs, so we're seeing countries starting to trade blows, economically speaking. The concern is multifaceted tariffs can mean higher prices for consumers here at home. They create massive uncertainty for businesses trying to plan ahead or manage supply chains. And that uncertainty can cause companies to delay investments or hiring. Plus, as CBS News noted, the U.S. economy was already showing some signs of slowing, and these trade tensions could unfortunately pour cold water on things.
It sounds like a significant headwind. But is it the only factor? Often these big market moves have multiple causes.
That's a crucial point, Grace. While the tariffs are certainly grabbing the headlines, analysis sourced via Perplexity API suggests the picture is more complex than just trade tensions being the sole villain since late February. Other factors are likely playing a role. Think about potential shifts in Federal Reserve policy regarding interest rates, recent inflation data perhaps spooking investors, or even pre-existing weaknesses in certain sectors like the tech troubles we already mentioned with the NASDAQ. We could also be seeing weakening corporate earnings forecasts, concerns about the global economy beyond just U.S.-China trade, or even a sense that the market was simply overvalued after its February peak and due for a correction. Investor psychology itself plays a part. Existing recession fears can make declines snowball.
That puts it into perspective. Looking back, how do these downturns typically play out? Are we talking a short dip or a long winter?
History gives us some context, though every situation is unique. According to CBS News and U.S. News and World Report, since World War II, the average bear market saw the S&P 500 fall about 33%. On average, it took about 13 months to go from the peak to the bottom, or trough. And the climb back? CBS News reports that took an average of 27 months. Some are much worse. AUS News reminds us the 2007 to 2009 financial crisis saw a 57% plunge. But, and this is key, the Seattle Times emphasizes that the S&P 500 has always, eventually, recovered from past bear markets. It might not always feel bearable at the time, but recovery does happen.
That long-term view is important. So for people watching their 401ks dwindle right now, what's the general advice? Is it time to cut losses?
The consistent advice from sources like CBS News, U.S. News and World Report, and the Seattle Times is generally not to panic sell, especially if you have a long-term investment horizon. Selling locks in those losses, and you risk missing the eventual rebound. Interestingly, some of Wall Street's best days historically have occurred during or right after bear markets. U.S. News suggests if you need the money very soon, selling might be necessary, but for long-term goals like retirement, riding out the volatility is often recommended. More sophisticated investors might shift to safer assets or even engage in short selling, as Perplexity API notes. But for most, patience is key.
Patience and perspective. Ethan, thank you for navigating us through those choppy market waters this morning.
You're welcome, Grace.
Many working parents are finding themselves in a real bind this morning, facing what is being called a deepening childcare crisis. Here to help us understand the situation is our reporter, Chloe. Chloe, what is putting the squeeze on families?
Grace, the core issue, as reported widely by outlets like the Associated Press and ABC News, is the end of significant federal funding that was put in place during the pandemic. We're talking about $24 billion meant to keep childcare providers afloat, and another $15 billion for assistance scholarships, mainly through something called the Child Care and Development Fund, or CCDF.
CCDFA? Remind us what that is?
Absolutely. The CCDF is the primary federal program providing childcare subsidies to low-income families so parents can work or attend training or education. But according to reports from the Atlanta Journal-Constitution, citing the AP, and analysis from Perplexity API, that pandemic-era funding expired back in September 2024, and Congress chose not to renew it. It created a funding cliff that everyone is tumbling down now.
A funding cliff sounds pretty dramatic. What are the immediate effects families are seeing?
They're severe and immediate. ABC News and the Associated Press are reporting that qualified families, often those with low to middle incomes, are increasingly being turned away or stuck on long wait lists. States like Arizona, Colorado, and Texas are specifically mentioned as having extensive waits for these scholarships. It seems finding affordable care is becoming less child's play and more of a major headache.
So long waits in some states. Are others handling it differently?
Yes, but not necessarily better for parents' wallets. Nevada and Oklahoma, for example, have reportedly raised the co-payments for families still receiving aid, or they plan to serve fewer children overall. And Idaho apparently had to completely pause enrollment in its child care assistance program for a time last year due to the funding shortage.
This must be forcing some incredibly difficult choices for parents.
Exactly. ABC News highlighted the story of Janeth Ibarra in Phoenix. She's actually a child care worker herself, but even with an employee discount, the end of a specific scholarship means her monthly bill for her twin boys is jumping to over $1,200. Another Phoenix mother, Brooklyn Newman, told ABC News she had to sacrifice time with her kids to work extra hours just to cover preschool tuition after her pandemic scholarship ended.
And childcare was already expensive, wasn't it?
Incredibly so. The Atlanta Journal-Constitution, via the AP, noted that back in 2022, the median cost for infant care in a center was already over $15,600 a year in large counties, and an amount out of reach for many without help. This funding cliff just makes a tough situation worse.
Beyond the funding itself, are there other federal concerns?
There are. Both ABC News and the AJC AP report mention concerns about federal oversight. Apparently, during the Trump administration, there were staff layoffs within the Office of Child Care. This office is crucial because it administers these federal subsidies and ensures states meet health and safety standards of things like running background checks and preventing fraud. Advocates worry these cuts could impact the stability and safety of the programs long term.
Has anything been done federally since the funding expired last September?
According to analysis from Perplexity API, Congress hasn't enacted major new funding specifically to replace that expired aid. However, there have been some related actions. The Biden administration finalized a rule back in February 2024, aiming for long-term improvements, like capping copays. There were also modest funding increases for some programs in the FY 2024 budget. Currently, government funding, including for these programs, is running on a continuing resolution, essentially extending last year's levels until September 30th of this year, Theta S 175 days from today.
So, no big rescue package yet. Any proposals on the table?
President Biden's FY 2025 budget proposed significant long-term investments, but that's just a proposal for now. ABC News mentioned Trump has suggested tariffs could fund childcare, though economists worry that could just raise prices on everyday goods, sort of robbing Peter to pay Paul potentially. Perplexity API also notes a bipartisan bill was introduced just last month by Senators Britt and Kaine to enhance tax credits, but its fate is uncertain.
With federal help shrinking, are states stepping up?
Some are trying. Perplexity API mentions Minnesota looking at expanding tax credits, Ohio exploring cost-sharing models, and Connecticut proposing an endowment funded by state surpluses. But as the initial reports from ABC News and the AP show, many states are clearly struggling, leading back to those waitlists and higher costs we discussed. ETA as a patchwork response right now.
It sounds like a very precarious situation for countless families relying on childcare. Chloe, thank you for breaking down this complex issue for us.
You're welcome, Grace.
Okay, here are some other headlines. In international developments, Iran's foreign minister, Abbas Araghchi, is set to engage in indirect talks with a U.S. envoy in Oman this Saturday regarding Iran's nuclear program. Oman, maintaining good relations with both nations, is serving as mediator. This comes after Iran corrected U.S. President Trump's assertion of direct talks, emphasizing the indirect nature which historically yields limited progress, especially since the U.S. withdrawal from the 2015 nuclear deal. Iran currently enriches uranium to 60% purity, nearing weapons-grade levels, though it maintains the program is peaceful. These talks occur amid significant U.S. sanctions and warnings from Trump about potential military action. Israeli Prime Minister Netanyahu was briefed and expressed cautious support. Previous indirect talks under the Biden administration were unsuccessful. Meanwhile, NATO Secretary General Mark Rutte, speaking in Japan, voiced concerns over China's rapid military expansion, particularly its naval buildup and exercises near Taiwan. Rutte stressed the need for allied cooperation, noting China's support for Russia highlights interconnected security risks between Europe and Asia. Japan, viewing China as a regional threat, is increasing its own military capabilities. The U.S. is also working to deepen NATO involvement in the Indo-Pacific, with Defense Secretary Pete Hegseth recently visiting Japan. NATO has strengthened ties with partners like Japan, South Korea, Australia, and New Zealand. Japanese Prime Minister Shigeru Ishiba has even proposed an Asian NATO-like framework, an idea China opposes. Turning to domestic news, colleges across the U.S. are reporting a surge in international student visa revocations by the Trump administration over the past month. Secretary of State Marco Rubio stated over 300 visas have been revoked nationwide since early 2025, affecting students at institutions like Harvard, UCLA, Stanford, and Texas A&M. Reasons cited range from minor legal infractions to political activity concerning the Israel-Gaza conflict, often with vague justifications. The Department of Homeland Security has also been terminating SEVIS records, impacting students' legal status. Universities are struggling to support affected students, some of whom are leaving the country or seeking legal counsel. In Kentucky, communities are waiting for surging rivers, like the Kentucky River, which crested near record levels in Frankfort, to recede before widespread cleanup can begin following severe storms. The relentless weather brought heavy rain and tornadoes, causing at least 4 deaths in the state and 23 across the region. Mandatory evacuations were issued, and the National Guard assisted with rescues. Over 500 state roads remain closed. Thousands are without power or water, and boil water advisories are in effect. Forecasted freezing temperatures could complicate cleanup efforts and pose health risks. Governor Andy Beshear urged continued vigilance. And finally, Health and Human Services Secretary Robert F. Kennedy Jr. announced plans to advise the CDC to stop recommending fluoride in public drinking water. This follows Utah becoming the first state to ban the practice in March 2025, opting instead for pharmacist-prescribed supplements. Kennedy cites potential health risks, referencing a disputed National Toxicology Program report linking high fluoride levels to lower IQ in children, and other concerns like hyperthyroidism. Public health and dental organizations maintain fluoride is safe and effective for preventing tooth decay. The EPA is currently reviewing fluoride's health effects. While Kennedy can advise the CDC, the final decision on fluoridation rests with state and local authorities. That's all we have for now. Today's episode was made by Alexander King with Claude Sonnet 3.7, Gemini Pro 2.5 Experimental, Gemini Flash 2.0, Perplexity Sonar Pro, and Google Cloud Text-to-Speech. I hope you have a great day. I'll see you tomorrow, Alex.